Welcome to our August 23rd episode of the Scientific Governance and Risk meetings that we've been having with Stephen Becker, our new president and COO. Generally, I've been giving some introductions, but I think that we're so far in the weeds, or I mean, sort of a recap, but we're so far in the weeds now that that might not be a useful endeavor. And I'm going to let Stephen take care of the recaps for us. So, Stephen, do you want to kick it off for us?
Sure. So to start off, just to get a sense of what we previously covered. We covered the risks inherent in generating DAI using CDPs. Now, just to recall, what were they? Qualitative risk, exposure, liquidity, volatility, correlation, and price feed risk. Now, the reason I'd like to repeat these is because the risk parameters that we are currently discussing, and we'll get into further, especially today, actually encapsulate 2 or 3 of these particular risks. So the one aspect that we actually did cover in depth was the qualitative risk component and the debt ceiling component. But for today, what I'd like to do is go over the debt ceiling component again, just to make sure that we have a good sense of clarity of what it is and what we're trying to achieve with it, and then possibly get into the liquidation ratio and sort of explore the extent of what that parameter is trying to control for, and how we can go about actually calculating that ratio and therefore controlling the risk. So what we know about the debt ceiling is that, as a start off, is that this is a parameter that is, we use to control for exposure risk, liquidity risk, and actually contributes towards correlation risk, where correlation risk we will have a look at maybe in another call. I don't think we'll be able to get to that today. But the one aspect that we need to start with is having a look at what the debt ceiling is briefly and how it's actually broken down. The first part of the debt ceiling that we need to look at is the theoretical debt ceiling. Now, that basically is a top-down approach in understanding what that means. What we're saying is that the trading environment is particularly liquid, and we think we can actually achieve a lot in terms of getting rid of big positions. But ultimately, how big must that position be before we start actually impacting the market to such an extent that we cause our own liquidity problems? So the debt ceiling as a parameter has this theoretical debt ceiling in place, which is, from a top-down approach, is just a percentage of the total tokens that are issued. So, for instance, we'd put a cap on it of, let's say, 20%. So that would be our hard stop at the top. So, if there is a token that has a market cap of $1 billion, then our hard cap from the top-down approach would be $200 million. Now, the second component, which is the practical debt ceiling, starts from the bottom and works its way up. And from that point of view, we start looking at what the trading environment looks like, what the liquidity environment looks like. We try to figure out what impacts we're going to have on the liquidity, and we also had to look at how the current liquidity will actually impact us as well. So there's a dual role over here that the practical debt ceiling tries to cover. And once we figure out what that practical debt ceiling is, we have a much more substantial sense of what we can be exposed to if the entire position of that particular token had to be liquidated over a given period. So the first one was the theoretical debt ceiling, which said, we are awash with liquidity. What is the impact we would have on that liquidity? The second one says, okay, let's start considering both liquidities, the one that is inherent in the market and the one that we will create by trying to liquidate this position. Now, the third component to the debt ceiling is more the defensive debt ceiling. And that helps us with a couple of aspects. The one thing that it does help us do is try to uniformly build the collateral portfolio so that we don't have too much of a diversification risk in terms of too much concentration in one particular token. But at the same time, the defensive ceiling allows us to start at a point and slowly grow so that we can also mitigate against massive volatility spikes that you might have in a particular token. You may find that some irrational exuberance may cause people to climb into a particular token to try and get margin exposure and a better exposure to the irrational exuberance that is underlying that particular token. We've got to defend against that because it will pose a risk on the underlying stability of the system as well. But one aspect as well is that there are possible attack vectors that could be used to draw up and to push up the debt ceiling for a particular token as well. So that defensive ceiling allows us to control for all those factors at the same time. It's a little bit of an ask, but instead of trying to fine-tune every aspect, we can actually start with a very simple nominal debt ceiling and then build it up slowly. So that basically is the debt ceiling in brief. And the one thing that you also got to keep in mind is that the debt ceiling does contribute indirectly to the correlation risk management as well of the entire system. So given that, I'll take a pause and see if there are any questions, either from the community or we have at the moment.
I want to actually jump in because I can and I have a microphone. So we'll get to Jordan's question in a second here. So the debt ceilings, from a very high level perspective, kind of represent the portfolio, how deep we are into each one of our asset classes, which represents sort of from a user perspective, their portfolio of investments. If we adopt a new asset class, a fairly large asset class, for example, would we have to rebalance all the other debt ceilings in order to compensate for or in order to maintain the proper levels of correlation across our portfolio?
There's a positive aspect to it and a negative aspect. The positive aspect is that if that asset was large enough and ubiquitous enough and had the liquidity, we could actually incorporate that into our portfolio with a larger than normal defensive debt ceiling. So let's say, for example, now we start everything off at $10 million each, and we slowly grow those $10 million each as we facilitate the growth of this of the system. We find that there's a silver-backed token that is incredibly liquid and is fantastic, and we would love to have that on board. If the portfolio allows for it, we don't have to start at 10, we could start at 50. Because it would be in relation to the portfolio as a whole, it would have a wonderful, I would say, negative correlation effect, which would add to the stability of the portfolio. But that being said, the downside is that it is very much dependent on where the collateral portfolio is at the moment. If you've got massive exposure to a concentrated exposure to Ether, and you've got this wonderful asset that's going to come into play, we've got to make sure that that asset doesn't include itself and just become a new concentration problem we have. So it is always with respect to what the collateral portfolio would look like. Again, we got to keep in mind that our objective is the integrity and stability of the system, not to grow an investment portfolio. So to that extent, we need to use the inherent risk features that we have created for ourselves, like the diversification benefit. We need to use that as capital buffers to make business decisions with respect to which collateral types we need and at what time. It's not to say that we're going to dismiss collateral types that wish to be a part of us. It'll just be more a case of, well, if you are very significant in terms of your trade representation, in terms of your size, that will be taken into consideration. But if you're not, you might have a very small debt ceiling, and that would grow exponentially as the whole system and as the whole collateral portfolio grows as well. Once again, this is not an investment portfolio. We don't have the ability to control uniformly how the collateral as a broad representation will grow in the portfolio. We can only set limits and hopefully find that all those collateral types will grow in unison together and then we can increase the debt ceilings for each of them and then see them grow as well. But that is highly unlikely. You're going to see concentration on one grow, and that might have to go up by itself, where others, it may take a little bit of time. So the kind of two-sided answer to your question is, yes, you would basically adjust for that collateral type. You wouldn't adjust anything else. And if that collateral type was too concentrated, we may have to just keep it a little bit more constrained until the rest of the portfolio catches up. But it doesn't take away and the negative side is it doesn't take away the fact that we would not include it. If it is a quality asset, it has to be included.
Mm-hmm. Okay, great. I think that does answer my question. Jess, I think Jordan had he typed something in the chat.
Okay, by liquidate this position, do you mean in the case of global settlement? The answer is no, or just if a lot of the CDPs for the asset are getting bit. That is correct in terms of determining the debt ceiling based on it. But yes, so it's basically in relation to normal operations. In this case, emergency shutdown is exactly what it says. It stops the whole system. But in terms of a normal operating system, when CDPs get bit, you've got to consider the fact that CDPs may be bit randomly because each person will have a different risk profile and they will have different collateralization to debt ratios. But I'm of the opinion that if you just take a very conservative view from a debt ceiling point of view and just assume that it was one very large CDP and it all got bitten at the same time in the normal course of operations, how would that affect the underlying market in which you want to actually divest yourself of that particular asset? These are basic thought experiments, but in those thought experiments, the application of which builds in natural buffers for ourselves. Not considering the fact that people have different incentives has a diversification benefit in there as well, built in, because not everyone is going to wait for, or not everyone is going to go and pledge collateral at 165% with respect to ETH as an example. You can have a distribution of CDP users. You can have a distribution of DAI users. You can have a distribution of keepers. All these aspects actually add in to the underlying risk mitigation of the system. But I'm not going to assume that they're there for me to use, but I will be able to use them when it comes to certain decisions with respect to collateral types. And then once that is basically discussed to the point that it's well understood, then it'll be very easy for Maker token holders to get risk teams in place for them to make decisions on the basis as well. The one aspect that is really hard to drive home, and I hope we can do this successfully through these meetings, is this collateral portfolio is not an investment portfolio. The basic premise of it is to ensure the integrity and stability of the system. So wherever we can get a diversification benefit from user distributions all the way down to the collateral distributions, we have to keep it inherent in the system. And as soon as we get a lot more mature and the economy becomes more broad and deep, you can then start using those diversification benefits in a more optimal way.
Bamsi, did you want to jump in and ask the question that you typed in the chat?
Yeah. So my question is, what if the defensive, again, to add to your point that you mentioned above before, what if the defensive debt ceiling that we've calculated is higher than the other two debt ceilings, like the theoretical one and the other one? So would it mean because for us diversification is more important, would the defensive debt ceiling take precedence?
So you think of it in terms of subsets. So the theoretical debt ceiling is the biggest component, right?
Okay.
Within that, the subset is the practical debt ceiling. And then within the practical debt ceiling, the subset is the defensive debt ceiling. So the defensive has to basically try and grow into the practical. And when it's reached the practical, that's where it stops.
Okay.
And it can only, then the practical can grow into the theoretical, given that the underlying liquidity becomes more prevalent. So there's this theoretical aspect within it, the practical aspect, and then within it you've got the defensive aspect. So the defensive grows into the practical, and we wish and hope that the market becomes so liquid that the practical also starts growing into the theoretical.
Right. Yeah, that makes more sense. Yeah.
Okay. Any other questions?
Yeah, so Jordan Crandall asked another question. He says, so we kind of have to concede that global settlement may seriously affect market prices for that market, correct? So that wouldn't be a limiting factor in the debt ceiling.
The one aspect, and this is probably for a much broader discussion, but emergency shutdown can occur for a number of reasons. You could have actually everything working absolutely perfectly, nothing going wrong, but in one moment you might find somehow a bad actor has got involved and is trying to influence the system in an untoward manner. Now, given the fact that nothing is wrong, you wouldn't have all the levers, triggering flags, but it would become evident to the global settlers that something is amiss, something is wrong. Maybe it's someone influencing the price. Maybe it's someone trying to, basically there's a lot of permutation. So trying to focus emergency shutdown on a particular collateral type or the collateral portfolio implies that there was some serious bad actor provisioning going on. And if that is the case, then you would get emergency shutdown. If you would have like a complete and utter black swan event happening, you can't think of that black swan event in a traditional sense where it's like this massive correction and we hope that it will eventually come back through policy mechanism. In this extent, the black swan would be something quite colossal. It might be more aimed at the Ethereum blockchain just stopping for some reason. I don't know how that would happen. I have no idea. But that kind of extent would be more systematic than it would actually be specific to the collateral portfolio or the collateral types.
Dempsey, do you want to ask that question for us? Because I was just about to ask the same one. Oh, he's driving. Dempsey asks, does this mean that emergency shutdown can be applied to individual CDP types?
Oh no, as I just said, that this is not the bad acting provision is mostly based on how the system as an overall mechanism gets attacked.
Sure, there's this existential threat that we need to think about. So,
yes. So this is a much broader concept because having a look at someone trying to manipulate an oracle price for a particular CDP type that has a current debt ceiling of 10 million. You'd look at it and go, well, that sucks. We need to basically, adjust for this quickly. But in terms of an emergency shutdown for that basis, one needs to take that into consideration, wait and say, well, this is not an existential threat. This is just messing with one component. And we need to basically drive home how we can fix that particular component.
I think so. The question is outside of this specific example that we're talking about right now, but in general, is it possible for us to shut down? So if we had a silver token, we realized that something hinky was happening there. Is it possible to perform an emergency shutdown on that specific asset class? Or is there a different term we'd use for that? Would we just simply freeze all trading or all CDP types? Yeah, it occurred to me that we don't.
I would imagine that there is a capability to do it. I imagine that there is a way that we could do it. But basically, it boils down to an oracle being influenced or a collection of oracles being influenced. And we do have security mechanisms in place to check the pricing before it affects us. If you use the silver, if silver does correct by 70% in one day, and you can see in the traditional market, and it becomes very clear and evident that this is the correction value, then that is the way the market is operating. And CDPs will be bitten, and most probably a large chunk of the CDPs will be bitten, and we need to make sure that the debt ceilings we have in place can obviously liquidate appropriately. But if there is a 70% drop in oracle price and it does not affect anything that in the market, and you know that the oracle is in fact being a bad actor, and we can deal with that within the security module that we have in place.
So that's interesting to point. That's a good observation. So there's a difference between an asset class just simply failing in a sort of a normal market manner, as opposed to a group of bad actors attempting to manipulate the system. So if silver does correct, then essentially people have paid their money, they took their chances, and then those CDPs will simply fail. And if the system is designed correctly, it won't present an existential threat to the rest of the system anyways.
The way I understand this is that you have to have we operate in an environment, and if that environment has a systematic shutdown, then it affects us. And that environment at the moment is the Ethereum blockchain.
Mm-hmm.
If for some reason that thing shuts off, something goes wrong with it, then by default, so do we. But in terms of us as a system, you basically have to identify the permutations of bad actors and either list them. If it's an exhaustive list, then that's great. But then on the basis of us being able to list them, we need to figure out what weighting we need to apply to them in order to assess whether something like that is critical and requires an actual emergency shutdown. I mean, it's a lot to take into consideration, but I mean, it's one of those things where it's so unique to us because we are thinking about everything from, well, we're attempting to think about everything from the details of how one actually goes about creating and generating DAI, all the way through to how the system operates in a cataclysmic event.
Yeah. So David asked, what mechanism is there to phase an asset out of the DCS?
What mechanism is there to phase an asset?
Yeah, to elaborate just a little bit, like, well, let's say some gold token becomes unbacked, but there's all these CDPs out in the system. Is there a way to sort of going back to partially globally settling or having some sort of mechanism to phase out an asset that turns sour without having to globally settle the whole system?
So basically, there's two ways. There's obviously the one thing that seems to be a natural understanding, and I need to basically adjust that, is that debt ceilings don't just grow. You may have to the trading environment may deteriorate. The fundamental qualities of the actual organization may pivot. These are the things that will fundamentally change the way the risk teams will perceive these organizations and their tokens. I mean, for instance, let's imagine that we used Apple stock as collateral, and then tomorrow Apple decided they don't want to sell devices anymore. They want to get into laundry service. I mean, Apple will absolutely just tank. Everything would just change. But the point being is, because everyone is constantly keeping an eye on Apple, the fact that they want to turn into a laundry service company would have probably been seen a long time ago. You would have seen it in the fact that their profits were coming down. You could see it in the fact that their devices weren't selling. You could see it in the change of management. These things would slowly give you the flags to start saying qualitative assessment is dropping. We may have to even consider excluding these guys from the portfolio in total. Further to that, you may even address the fact that the trading environment has changed. It's one of the basic aspects of understanding when a potential correction or crash comes along is having a look at the behavior of the market just before it actually occurs. There is a sense of erratic behavior where things become very hectic. Folks do not understand whether they're coming or going. It doesn't mean that it is going to foretell the future, but it generally gives you a good indication. And then from there, risk teams could pick up the change in the nature of the trading environment, which should affect the underlying figures, the calculations, which then should start bringing down the debt ceilings. If you have a binary event, that I concede is a lot harder. If something happens tomorrow, we need to jump on it and do something about it. But it really boils down to the extent to where the MKR token holders' risk team representations missed that. So what happens? So David goes on to say, what happens when you need to lower the debt ceiling, but there's a maximum amount of DAI drawn for that asset already? Will it just happen at the extra die of the debts? Well, the thing about the debt ceiling is that obviously you are going to have to first message this out and say, listen, we need to drop the debt ceiling. In terms of actually dealing with something that is frantic and hectic, like dropping the debt ceiling, let's say from 20 down to 10, but there's already 18 now. So that means for some reason you've got 8 million DAI out there that needs to come back. Well, either you can do it in a very progressive format and transition slowly, or if there's something drastic, it just pretty much will have to be a case of, well, no more can be taken out. We have to actually cap it at the 18, but the effective amount will be 10. And then folks will start, hopefully, bringing back their DAI and closing out their CDPs. That event, I mean, I can't give you the absolute details of what happens in that event, but I mean, it's a very good point.
So I think the assumption would be that if we had a Tesla-backed asset class, and then somebody was watching Tesla tweets, they would probably, or Elon Musk tweets, they'd probably get a sense that something was not great in the world of Tesla, and they would start, bringing down their CDP positions, to start paying back DAI, right? So the expectation is the people that opened that class of CDPs would be watching the oracles and watching their own ecosystem and trying to get out of their position.
I mean, David's question is spot on. I mean, there are certain reactive components that we have in place, but in terms of all the possible permutation of events out there, you try to cover for as much as possible, but there's, the thing about a black swan, and everyone talks about it as a thought experiment, but the way that it manifests itself is never in a way you expect. I mean, that's why if you read, and I have read a million risk management books, they're so useful because they're all hindsight. When they talk about long-term capital management and its demise, they talk in hindsight about how too much risk was taken on, the leverage was almost infinite, and so on and so forth. And you think, well, you are talking about prize-winning mathematicians and economists. It's not like they didn't consider that. It's just that when Russia defaulted and it took them into a tailspin, not just because of the default, but because of what their counterparties did as a consequence of it. So these things didn't just come from like a miscalculation or a misassessment. It comes from the overarching fact that when something goes wrong, the domino effect that you get from that is never going to be something you anticipate. So you got to basically do this thing called stress testing, where you think, okay, well, if the worst case I've ever seen is a 10% drop in one day, then you have to start with the words like, let's assume that it's 15% and not 10. And the problem with that is that you go to your board of directors and you put forward a risk stress assessment at 15%. They're going to ask you, where did you get that figure from? And you say, well, it is to basically encapsulate those risks we can't even think about because we have no idea how they're going to look. And we may have an order of magnitude that is so low that we don't know. So the point being is to make sure that your exposure to all these possibilities is constrained into a world where you think, okay, what can you do from a rigorous point of view? What can you do from an economic capital point of view? And then there's just stuff that you cannot possibly even fathom. But because you've kept your exposure well contained and well controlled, if you do have an absolute, cataclysmic event that you can, pigeonhole under a black swan, it's just that you are more likely to come out of it on the other side. That is effectively what risk management does from that absolute point of view. It just increases your chances of survival.
All right, it looks like there was a conversation going on in the chat. I'm not sure whether any of those questions were directed at the meeting or at each other. So it might be a good point to move on to, do you think we're ready for a liquidation ratio?
I think so, unless anybody has any questions with respect to the debt ceiling. The one thing about the debt ceiling is it highlights a very important feature. And the important feature is liquidity. I remember the first time I joined an investment bank, I was sitting around a boardroom table, and the head of operations posed a question to everyone saying, what is the most important risk that you have facing a trading bank other than operations? And everybody was going, oh, volatility, oh, this, oh, that. And it became, she just looked at everyone and said, no, it's liquidity. Liquidity is the underlying defining factor of your ability to trade. And liquidity assessments on a continuous basis is really the thing that you've got to keep your eye on at all times, because you've got to assume that when you create your debt ceiling, and very much like when you create your liquidation ratio, that liquidity that you see will persist for a given period of time. It is unfortunate you can't decide that everything works really well now and then we assume tomorrow it all disappears, because if that's the case, then those are bad assumptions and we shouldn't be doing business in that environment. You have to basically make critical assessments in terms of saying what we see now can persist for at least the next 3 months. So assuming the liquidity provided, so the liquidity profile that you see there actually has that persistence, then you can do calculations off the back of it. Some of the stuff seems a little sort of vague, but ultimately you must remember that we're talking about participants in the market, human beings participating in the market. There's a group psychological dynamic that ensures people gravitate towards a common cause, which is incentivizes them to trade. So ultimately, if that incentive is strong enough and that gravitation is strong enough, your liquidity will come as a consequence. If you note that during the 2007-8 crisis, the biggest concern wasn't the fact that there was a massive credit crash. It was the fact that the banks decided that they did not want to provide any liquidity whatsoever. So even when they had the firm foundation to actually carry on lending to each other in the interbank market, they refused to do it. And because their incentives were not aligned, they didn't gravitate to the one point of trading around their Fed funds. They didn't trade around the money that they had in their banks. They didn't want to lend it out because their incentives were gone. And that is the underlying idea that you want to keep in the back of your mind when you think about liquidity. Is the incentive always there to keep trading? What is causing people to gravitate towards wanting to trade? And that pretty much is the very premise of majority of where all your risks go wrong. It's when you don't consider liquidity. So that being said, let's see, are there any other questions before I hit liquidation ratio?
Yeah, so in the same theme, David asked how we would account for a sudden unexpected loss of liquidity, or would that risk just be a part of the liquidity risk figure?
You would, as I previously mentioned, you have to make an assumption that the liquidity profile that you see today will persist for a certain period of time. You can't assume that it's going to be exactly the same next year, but you can make the assumption that it's going to be pretty much the same over the next 3 months. Obviously, this is statistics, so you'll have confidence intervals, you'll have all these metrics. Your bootstrapping will tell you that how far your metrics may be off, but the point being is that the underlying assumption is your liquidity profile will persist over the next 3 months. In the crypto space, 3 months, I reckon, is about the longest you can push it. In the traditional space, most people go for more like 6 months to a year. Looking at risk management and assuming the current liquidity profile. What is interesting on that basis is that in the traditional sense, when you look at liquidity, it's regime dependent. You may have a current regime that is bullish, like in when quantitative easing came into existence in 2009 and QE2 again, it bolstered the whole market. So the regime turned from a high volatility bearish market into this low volatility sponsored bull market. So the regime shifted, the volatility profiles changed. So that aspect has a cyclical nature which folks try and keep into consideration. crypto hasn't been around long enough to actually start formulating these proper cycles, to expressly find definition in cycles, because the economy hasn't grown as such. But given that, you need to be cognizant of the fact that you need to express some sort of confidence in how this profile, especially liquidity profile, will persist over a certain period. Maybe 3 months is too long. Maybe it should be monthly. But from a risk team point of view, the MKR token holders need to mandate the risk teams to be cognizant of it every day, if not in real time. Okay, so with that, what's our timing like? We've got about 15 minutes. So I'm gonna spend 5 more minutes on just going through the start of the liquidation ratio, and then we can open up for any more questions or dialogue. Or if people wish, I can carry on just speaking about liquidation ratio. So the liquidation ratio is a parameter that encapsulates 2 risks: volatility and liquidity risk. Now, the liquidity risk assessment is a little different to that which we do for the debt ceiling. The debt ceiling is more concerned about the size of the ceiling and how that affects the actual underlying liquidity profile of the stock. Here we're looking at the liquidity assessment from the bottom up. We're basically saying that if I hold a CDP and I wish to liquidate, so the CDP gets bitten and you basically buy the collateral and you wish to liquidate it, you are more worried about the liquidity profile that you're about to trade into. Where the debt ceiling, you're more worried about liquidity profile that you're about to trade into and impact. So the liquidation ratio just says, well, let's figure out what that liquidity profile looks like and then consider the next issue, which is volatility. So let's chat about the volatility component for a second. Given a specific point in time, like today, what is the likelihood of token ABC dropping by 1% in one day? Now, that statement is very important because it's made up of 2 components. The first is the extent in terms of value, that being the 1%, and then the second is the time period. Now, that encapsulates the full extent of a risk expression so that you can find an answer for it, because there are 2 ways that you need to look at it. Either you're worried about the percentage move and the time period to get a sense of the probability of it happening, or you want to know the probability of something happening over a time period to figure out what the extent of that may be. Does that make sense before I carry on? Does everyone?
I think so. Maybe I have a question. I might be jumping ahead. Or how is that probability determined? Is it just straight looking at historical data? If it's happened before, it'll probably happen again, or is there some technical analysis built into the system?
Let's not use the phrase technical analysis, because that is generally something that is kind of misconstrued. It's a set of tools that is used mostly for trading, but it's generally related to like throwing bones or some sort of mystical thing. And I don't believe in that interpretation. I think technical analysis has first principles that people are ignoring in terms of the trading environment, but I digress. What you do now is, to the first point, when you say you've got a percentage move, what's the probability of it being realized over a specific time period, is a question that you have to relate to the underlying distribution of the returns of that particular asset. And so what you do is take a certain time period, generally more than, let's say 1 year. It depends on the regime, but that's another subject altogether. Let's say you take the returns of 1 year and you map a distribution onto it. Either you fit a distribution to it, you say, well, this is the look and feel of the distribution. If we had to go and put a normal distribution, a Gaussian distribution over it, what would those parameters look like? I mean, you might get your normal distribution is defined by 2 parameters, the mean and the standard deviation. You might find the mean is plus 0.5%, and the volatility is 1 or 2%. And that defines your Gaussian representation of the distribution you've seen over the last year. And then given that, you can then answer the question, what's the likelihood of seeing a move of more than 1% in one day? You have a look at the left side of the distribution, which is the positive side, and it'll tell you, well, an up movement, you might probably see only 3% of the time. But in terms of a down movement, you might find that more like 5% of the time. So given the percentage movement over a specific day, you can go find what these probabilities are. Now, what we want to do is reverse this around. We want to start with the probability and go find out what that percentage is. So we want to say, given this example I've just mentioned with respect to the normal Gaussian or bell curve distribution, you can ask the question, what is the chance, what is the extent loss or the extent gain that we will only see maybe one every 20 days or one every 100 days? In other words, what is the level that we can sort of peg in the sand where anything that happens below that has a 1% chance of happening or a 5% chance of happening? Now, if you have a look at the distribution, you go to the tails and you add up 95% from left to right, and whatever value you come up with at the end, that will be the number that you see. Now, if we used our simple example of a mean of, let's say, 0% and your volatility of 1%, then your 95 would be around about sort of your 1.6% range to 1.96% range. I think 2.33 is 1%. It slips my mind, sorry. But you would say that the probability of seeing something happening greater than 1.6% in one day is a 5% probability, or something that goes further than 2.33% in one day has got a 1% probability. Now, once you've figured what that is, then that actually starts becoming a little bit more interesting for us, because now we know what the extent of the distribution we have to cater for, because the liquidation ratio says, well, if something goes wrong, how much of a buffer do we need to ensure that we can get out of the position and still realize the full value of the loan that was made from the CDP? So if you have a look at ETH, for example, a simple calculation would be something called value at risk. And value at risk, the driving parameter underneath that is actually volatility. You do this thing that I just mentioned to you. You create you fit your curve. You find the extent that weighs up what the percentage at risk is at a 1% level, and that might tell you that over one day you've got a chance of losing 2.33%. Now, if the liquidation ratio needs to cater just for that, then that liquidation ratio would be 102.33%. Why is that? Because when a CDP gets bitten and you purchase that collateral and you want to basically sell it, you are surmising that it's going to take you just one day to get rid of all that collateral. And let's pretend for a moment that the liquidity is there for you to be able to do so. So the only thing that you're exposed to is the fact that there's a 1% chance that you could lose 2.33% of the value of your collateral at the time. But because you have 2.33% more, well, it should be more like 2.45% because of compounding, you should have enough buffer to get rid of your collateral and realize your full 100% of your loan. And that is wrapped up in the probability of 1%. So you've got a 1% chance, theoretically speaking, from the calculations that we've done, of losing more than 2.33%. So that is the volatility component that goes into the liquidation ratio. It gets adjusted by the liquidity risk component, because you might say, well, the CDP, I've got the CDP that was bitten, I bought the collateral, I'm about to sell the collateral on the market, and this, I might actually start thinking about trying to get rid of the collateral over a couple of days, not just right now. Because if you want to trade the position out in a more reasonable manner, as opposed to just taking it and dumping it on the market, you may get a certain benefit out of that. So there's this weighting that you have to consider. The one is that if you just drop everything right now, Sure, but you expose yourself to the inherent liquidity risk, and if it's a very big CDP, you might even have a little bit of endogenous impact as well. In other words, you may force more liquidity risk, which will go against just the volatility that you've calculated. So the liquidity risk might add on an extra 50 basis points or maybe 1%. So you start off with 2.33, you add on 1, that means you've got 3.33% that you need to add on to the 100% loan that you've taken out, and that becomes your liquidation ratio. But then you say to yourself, well, you've only considered 1 day. You've only considered the fact that you're trying to get rid of this collateral over 1 day. That's kind of silly, because everybody needs to have a considered way of trying to get rid of the collateral. You need to expand that time period a little bit more so that folks can have a more concerted effort in getting rid of their collateral. And at the same time, you need to make sure that you can look after the system. So instead of looking at it over 1 day, you may look at it over 7 days. And that's pretty much the number I've picked. And I can go into that number some other day, because there's a bit of an argument that one can form from that. But looking at 7 days, you could then increase the buffer that you require by using Gaussian, the square root of 7. So that will take you to around about 9, maybe 10%. So your liquidation ratio for this little example might be 110%. Now, I'm sure right now people have a million questions or may feel a little bit baffled. So I'm happy to go over.
Yeah, I have a few questions on it, but I know you have a hard stop and we only have 4 minutes left, so I don't know if we have time to dig into this. But the way that we deal with seized collateral and we attempt to liquidate it in the CDP mechanism is right now through a direct sale on the dashboard, and in the future it will be through a rather sophisticated auction mechanism. So when you're predicting the liquidity of a particular asset class, you're also the risk teams also have to factor in that the first mover in that system are going to be people interacting with the auction mechanisms. Is that true?
Yeah. I mean, the first aspect about this is saying, excuse me, my computer just is going a bit weird on me. There's two aspects. The one is, in the liquidation auction, you buy that collateral, right? And hopefully you get some sort of benefit from it, i.e. a discount. And then once you have that collateral in hand, what are you going to do with it? Now, in the crypto space, this becomes a hell of a lot more interesting, because in the traditional space, what you do is someone defaults on their house, you go take their house, you sell their house, you get dollars. Yay, everyone understands that. But in the crypto world, you've got these interesting liquidity vectors that you have to consider. You don't necessarily have to go from that collateral into US dollar or into fiat. You could go from that collateral into maybe the native token of the blockchain, because it should, theoretically speaking, be more liquid and be the representative currency for that particular system. The other thing you can consider is all other collateral or all other tokens that may have more liquidity than it. So you might see that a CDP gets bitten and you purchase token ABC. But you find that there is about 7 tokens that are much more liquid than it. And you may find that there are many avenues that you could have a look at in terms of trying to get rid of that particular token into those other more liquid assets. But it's interesting because it gives you all these permutations, but it's also very difficult because ultimately you can't really figure out what is going to be the best representation of liquidation.
Well, I hadn't considered that. So in the traditional finance world, the capacity for liquidation is how quickly you get into whatever your local currency is. But in crypto, there's no clear lines.
Yeah, you might find that people want to get rid of their collateral and to die.
Wow, yeah, that's complex.
So it's very interesting, but the complexity gives you opportunity. And opportunity means that you've got all these very intricate possibilities of arbitraging. You've got all these intricacies where you can see possibilities of providing liquidity to systems. It's just, the whole thing is interacting to such an extent that if it is done appropriately, there's this sort of net benefit, this virtuous circle of benefit that you actually employ into the whole system. The crypto space is so interesting because of all the different vectors you can take. The different granularities in terms of interpreting tokens will give you another sense of it. What happens if you are getting a utility token? You might want to get a utility token and sell it out for a security-backed token, because you've got a different play between utility and stocks. You might have a different play between a governance token and a currency token. There's so many ways you can see this, that by just defining the fact that you liquidate into cash is the sort of default mechanism everyone has in their heads. But the opportunities abound. The permutations are crazy.
Mm-hmm. Well, that's another mind-blowing concept to close the meeting on. I think that there's David and Jordan, you had some interesting questions. We're not going to have time to get to them today, but I'm going to put it in our doc for the next meeting, and we'll get to them then. Thanks, Stephen. That was amazing.
Thank you, everybody, and I appreciate the questions. I really do. Thank you very much for those.
Right, I'll be posting this to YouTube and on our subreddit soon, so look for that there. Thanks, everybody.
Thanks.
Thank you very much. Keep well.